Welcome. Today we're going to present to you Texas Standard Energy Fund 2, which is now available. TSE is a limited partnership whose primary objective is to conduct oil and gas drilling and development activities in the targeted areas of the Barnett Shale Combo region of North Texas, tapping into proven resources. In addition to the economic benefits of selling natural resources, investors may benefit from tax benefits relating to deductions for tangible drilling costs and depletion allowance. The fund believes that it's identified opportunities to provide investors with certain tax benefits and cash distributions through multiple revenue streams, including crude oil, natural gas, and liquid natural gas. The fund is restricted to accredited investors. Now, generally, accredited investor means that you're an individual or joint couple with net worth that exceeds $1 million, excluding the value of your primary residence, or you have an income exceeding $200,000 in each of the most 2 recent years, or joint income exceeding $300,000, and a reasonable expectation that that same income will continue in the current year. Regulations require us to make the following disclosure. This communication is not and should not be construed as a final offer, solicitation, or sale of any security, and the information expressed herein may be changed at any time without notice or with obligation to update. All offerings of securities shall be completed only by the applicable offering documents. Such offering documents are set forth in the terms of the offering, including the use of proceeds, risk factors, and other relevant information applicable to such offering. The presentation is for informational purposes only and is not intended to provide sufficient basis on which you should make any investment decision, and should not be regarded as an offer to sell or solicitation of any offer to buy any financial product. Any such offer shall be made solely pursuant to the private placement memorandum. This presentation does not constitute any form of accounting, income tax, or legal advice. All investment strategies have risks. Past performance is never an assurance of future results. With all that said, Avi, I want to introduce you. Avi is my fellow advisor here at Metric Financial. We are both registered representatives of the firm. And Avi, I know you want to introduce our other 2 guests.
Thanks, Brian. So joining us today are our 2 special guests, Rodney Hughes. Rodney is the founder and CEO of Texas Standard Energy. Rodney has over 45 years of experience in the oil and gas industry. In his largest project, 92 vertical wells were drilled across 12,000 acres of leasehold and sold to a large acquirer. His activity in the Barnett Shale has covered the dry gas, wet gas, and combo regions. Also on the call is Philip Jensen, Managing Director at Skyway Capital. Skyway Capital is a leading middle market investment bank specializing in mergers and acquisitions, capital markets, and private capital advisory services. Skyway Capital is the managing broker dealer for Texas Standard Energy. And with that, Philip, why don't you take it away?
Yeah, thanks, Avi. Thanks, Brian. We appreciate you guys coordinating this call. You guys have been a great partner. Metric's a great partner, and so is Texas Standard Energy. So Skyway Capital Markets is the managing broker dealer, and I'm a managing director with the firm. I'm going to highlight what we think is really unique about Texas Standard Energy. There's a lot of things that are unique, but I think 3 of the most things that set it apart from other drilling partnerships is one is the proven reserves. And it's a proven reserves or classification that Haas Engineering, a third party, has given the acreage that Texas Standard Energy controls. And we'll talk more about that in a minute. And then Brian mentioned that Texas Standard Energy is drilling for 3 commodities. That's going to be oil, dry natural gas, and natural gas liquids, which is also unique because typically drilling partnerships are going to focus either on gas or oil. In this case, the investor has the opportunity to partner with a firm that's drilling for all 3 commodities. And then finally, there's material tax advantages, which I'll quickly cover as well. on this call, but we've got a third-party CPA that can help with that, and I'm sure Avi and Brian have resources that can help with the tax advantages and understanding them and making sure that they apply to individuals that may want to invest. Disclosure screens, I'm not going to go into this. I know that Brian covered a lot of the disclosures, but from the energy side, obviously there is volatility in all three of the commodities that I just talked about. Gives a natural hedge in that when oil's up and gas is down, that our production helps offset some of that. I do want to mention that there was 4 layers of due diligence that's done on this partnership, because Skyway, our firm, reviewed Texas Standard Energy and Rodney and his team. Then there's a third-party firm called Myth Law. They do a review looking at the PPM, the executive team. They do a deep dive into the offering. And then Metric Financial has their own. And then Haas Engineering is a third-party engineering firm that looks at all the data, and that gives us the classification for proven reserves, which is the best classification that we can get for the reserves in this partnership. So quickly on the tax benefits, it can get complicated, but at a very high level, there's what's called intangible drilling costs. That's been part of the tax code for over 70 years. And what it allows for is that the costs that go into drilling the wells, 75 to 85% of those costs are actually passed on as an IDC, an intangible drilling cost, that investors will get on their K1 for 2024. You invest this year, you'll get a K1 with 75 to 85% of those costs being passed along to the investor as a deduction against active income for 2024. So hypothetical, you put 100,000 in, you got $75,000 to $85,000 in deductions against active income for 2024. So very material. And then there's additional benefits with tangible drilling costs that gets passed along in future years. And then the income that's produced once the wells are producing, have production and sell the commodities, that income, 15% of it has a depletion allowance, which is an additional benefit to investors. So high level, 3 material tax advantages. Happy to help with putting together a hypothetical, or you guys can work with Avi and Brian, their team, to understand the benefits that may apply to you. Just real quick, I'm not going to spend a lot of time in this, but energy, I think a lot of folks have questions whether oil and gas is going to be around. This is from the U.S. Energy Information Administration. There's projections that oil and gas is going to, both on the consumption and production side, is going to be needed well out for the next 30 to 40 years. There's a lot of reasons why these projections are being made. The most material really is that the world's population is continuing to grow, and as we have more people in the world, there's more need. There's a higher need for energy, and really, it's going to be energy across all energy sources: wind, solar, oil, and gas. And this is just kind of a forecast in the coming years based on the U.S. Energy Information Administration. So the government puts out this data. So I transition to the actual partnership and where Rodney and his team has focused their efforts in this drilling partnership is going to be drilling wells. It's the Barnett Combo. It's north of Dallas, Fort Worth area, the Metroplex area. Rodney's been drilling in this region and has lived there as a rancher for 45 years. So a ton of experience in the basin. It's been historically dry natural gas, but the combo, as we've talked about, is a region that produces all 3 of the commodities that we've mentioned earlier. So very unique and beneficial for investors to get diversification in all 3 commodities. These are the 3 commodities. I'm not going to spend a lot of time, but dry natural gas comes out of your stove. Natural gas liquids is a primary component for plastics and a lot of other uses. And then obviously oil, which the oil that's produced is sweet crude, which gets a higher a premium in pricing that's being produced from the wells from the region that Texas Standard Energy is drilling in. And lastly, before I turn it over to Rodney, they're not doing any wildcatting. There's wildcattings back in the day when they didn't have a lot of data, and they would drill a well and not have a lot of information and hope that they would hit oil, dry natural gas, or natural gas liquids. In this case, we have proven reserves, which is the best classification from Haas Engineering that we can get for the fund. So I'm going to turn it over to Rodney, let him talk a little bit about the partnership, where we're drilling, because it's not a blind pool. A lot of times, these funds will raise capital and determine where they're going to place it. It's they're very laser focused on a particular region. And I'm going to let Rodney talk about why that region, the success they've seen in the prior fund, and the opportunity for investors in the fund this year. Rodney, I'll turn it over to you.
Okay. I want to also say thanks to Avi and Brian for helping this happen today. We have been active in this region since 2004, holding acreage. Our acreage benefits from two large operators, EOG Resources and Pioneer, in that they drilled 2,500 wells over a 8-year period, 8-year period, starting in 2007. The best 14 of those 2,500 wells offset our acreage, which then those wells were drilled in 2011 and 12. So with that as the proof that our acreage position was valuable, probable. In 2015, Hass Engineering gives us a proven reserve report that said that we had a potential of 107 drilling locations within the boundaries of that acreage block. So we have maintained that by leasing on like a checkerboard basis over the years, awaiting a market where natural gas liquids and crude oil held a value that would be making an economic effort. Over that period of time, there have been a lot of technical advances, frac strategy, the way you produce the wells following completion, all those things go into making a successful operation. A very critical aspect of it is having seismic data that tells you the viability of the rock you're about to drill in. So one of the things we've done is we purchased the seismic data from EOG that is under those 14 wells, along with 3 different increments of seismic data. That put us in a position to compare the rock we were about to drill with rock that has 10 years of production history. So, and currently we are planning, had a 3-hour Zoom meeting yesterday with our team, Hass Engineering, John Huggins, who's our geophysicist, reporting on his ideas for drilling locations, etc., for Fund 2. We have 8 locations immediately west of 3 of the wells that are producing from Pad 1, from Fund 1. We have 4 more that he recommends immediately south of the other 3 wells. Fund 2 is going to benefit from infrastructure. We have gas pipelines, we have water disposal wells. First of all, you're going to make back a lot of the frac water that go into these fracs, 200,000 barrels per well approximately. We're drilling, I think the 6 wells in Fund 1 are average about 8,500 feet in length in the ground, 7,000 down to the zone. So I think the longest one was a total depth of 16,500. So we have our own injection wells that allow us to dispose that water for 20 cents a barrel, whereas all the previous operators have hauled that water to commercial disposal at a cost of from $1.50 to $3 a barrel. And you're going to get back for sure a third of that water. So it's an immense cost savings, adds to the profitability of the operation. So Fund 2 is going to drill, several wells, we hope, and we are preparing today to be able to start drilling September 15th. We have there were 2 drilling rigs built by a large Canadian company in the 2010-12 era that were specifically built to drill in the Barnett. So the burden for us is to execute. We just did that with 6 wells, and we have we're 60 days into productive life on those wells. They're better than our projections, and all of our projections and all of our data is provided by Hass Engineering, which is a third-party reservoir engineering firm. So I don't have an in-house engineer that's paid a salary that has a direct benefit from any of the reservoir evaluations we use. And I've had that relationship since 2004 with Hass, and they've been very valuable to us.
Rodney, this image that we're looking at, is that an image from Haas?
So, yeah, what that is those were wells drilled in the Combo region where we are. The yellow block is our acreage position. The red circle defines the area of the 14 wells that we're keyed off of. So the proximity of our acreage is it couldn't be better.
And what do the different colors represent of the different colored wells?
It's different operators.
Oh.
Yeah, the greens are Pioneer, and the blues were EOG.
Okay.
Yeah, so the offering overview for investors, we're looking to raise 100 million, which would the cost of each well is roughly 4 to 4.5 million. So we're looking at 18 to 21 wells as the target for this partnership. As Rodney mentioned, they've already identified the first 7 specifically to get the drilling started this year. And then the IDC cost, again, targeting 75 to 85% of the well cost will be an IDC deduction. And then there is a split, 80-20 split from production. Once the wells come online and production starts, investors will get 80% of the distributions, and Texas Standard Energy receives 20%. So this is what's different from other offerings, in that the distributions, Texas Standard Energy is not marking up the cost to coordinate drilling all the wells. There's other operators or partnerships that'll mark up a cost of a well from 5 to 15%. They're aligned. Texas Standard Energy is aligned with investors that they got to get production online in order to really receive any type of revenue. So they're aligned with investors to drill the best wells and get them online as quickly as possible. And Rodney will tell you, it's not always about quick. It is about doing it the right way. And so sometimes it takes a little longer than might be planned for, but overall life of the investment, it makes sense to take their time in some cases. But I say, that being said, last year's partnership, we raised the money, closed at 12/31. The wells are online and then sending out distributions by June. So, and I think we're on ahead of schedule of that this year. So, in line with getting distributions out within 6 to 9 months of closing the offering, which is the end of this year, getting distributions by the summer next year.
One of the risks mentioned for the fund is the price of oil. Speak about how you're managing that risk, and what would be is there a break even number that oil would need to be at for this to be a profitable fund?
That's a great question. I'll start, Rodney, and then you can add to it. So our models show break even or in the mid 30s, that oil would need to go to the mid 30s, and that's going to be the largest percentage of revenue for the partnership is going to be oil. You know, we're in the high 70s, 80 range. It would need to go down to the mid 30s or below, you know, and stay there. Let's say mid 30s and stay there for the life of the fund. We didn't see mid 30s until COVID hit, and we only saw it for a short period of time. Anything lower than that, it rebounded pretty quickly. So, you know, to us, in a worst case scenario, the wells would continue to produce in a period of low pricing, but you know, you're going to continue to have production through that downturn, and then it'll, you know, most likely rebound. So we don't put any hedging in place, because typically there's a cost with hedging the production. We feel like there's a natural hedge, which is a material benefit to investors, in that there's three commodities, because dry natural gas and natural gas liquids and oil they don't have a, you know, core. I mean, they will move in some cases together, but there is a lot of diversification in the pricing. When, like right now, dry natural gas is low, oil's fairly high. So there's diversification in pricing. And I don't know, Rodney, if you want to add anything to that.
I think you covered it. You know, three streams of revenue coming from every well is a hedge. So, and your 40-40-20 as the ratio of revenue, and they also don't trade. There are relationships, but one is, they're all priced in separate markets with different demand sources, etc. So we're in an area where rapidly growing Dallas-Fort Worth metropolitan area, growing 300,000 to 400,000 people a year. We've got 8 million people here burning natural gas. We're 40 miles away. The liquids market is, our liquids go in a pipeline about 30 miles from where we produce it. It goes to Houston. It's sold to buyers in America, are along the Gulf Coast, or exported to, most of it going to Asia for plastics production. The LNG market, which is liquefied natural gas, is providing a big boost and support to natural gas in general. Having said that, natural gas prices are really low right now, primarily because of federal government manipulation. We committed an awful lot of LNG to Europe when Russia attacked the Ukraine. The U.S. committed to support Europe with lots of LNG, and now for political reasons they've put restraints on that a little bit, which are, by the way, coming off slowly. But again, the growth in the demand for natural gas around the world is incredible, because you have all these economies that are converting from coal to a cleaner burning fuel, and you can't get one that's less expensive and dependable than natural gas. And the fact that you can now liquefy it and ship it on a big vessel has made it available to anybody that's got a port that can accommodate that. And I want to mention this. We want to sell this asset at some point, but you cannot approach it from the standpoint that, okay, so we're gonna drill, produce, and automatically sell it, put it on the market in 3 years. You have to start on the assumption that you'll never sell it, that you will always have to produce it. So you equip it like that new owner would want it. So you don't cut costs, you don't put out a cheap model. And I'll just say that we have already had one inquiry. Some of the production data is beginning to leak out a little bit, and frankly, we're trying to hold a tight line on going public with our production data. Eventually, because becomes public, we won't be able to restrain the market in that sense. But anyway,
is it fair, Rodney, to say that, and Philip, the expectation is, you mentioned in your modeling that distributions would start 6 to 9 months after production. So we're looking at 6 to 9 months into 2025. And then the expectation is they'll continue for a number of years until we find a suitable buyer for the wells. Is that right?
that's correct.
Okay.
Yeah. So yeah, we in our models and projections, we have a production starting 6 to 9 months, but then investor returns based on the production numbers that we get from Haas Engineering, and the offset wells being the 6 from Texas Standard Energy Fund 1 and the 14 Pioneer wells. We have investor in, pricing being in the ranges that it's in today, investor returns based on production within 24 months after production starts. So 24 months from the middle of next year, if pricing stays in the ranges that we have today, then investors would get their principal back, not including the tax advantages. And then we're looking to sell the assets and put them in the market 36 months. And as Rodney mentioned, there's already some interest, and there's buyers for stable production, and typically that would be the dry natural gas. The oil is going to come out faster. We're going to sell that, and then have a portfolio that has stable natural gas production.
I think you also mentioned that this fund might offer some early investor discounts. Is that the case?
That is. We're it helps the partnership to raise because it closes 12/31, raise the capital sooner, get it to Rodney and his team so they can drill the wells faster, right? Getting it deployed. It's a return of a time value of money in order to get that deployed and get the investors their distributions faster. So we're incentivizing investors that get in August, this next month. We're discounting the units by 10%. So a unit is $1,000, minimum investment's $50,000, but the units would be $900 per unit. So they get to buy more of the partnership by getting that discount on those units.
Well, thanks. I know we ran a little long today, but I thought it was helpful for our investors to hear and to see you guys. So thank you so much. And if you do have more questions, contact us, contact your advisor, and we look forward to speaking with you. Thanks to everybody.
Appreciate it, Avi.
Thanks, Robbie. Thanks, Phil.
Thanks for joining.